Welcome to The Unconventional Path, Entrepreneurship and Innovation Stories and Ideas. Hello, I'm bela.and.mike.
And I'm Mike Wasserman.
Today, we are excited to be joined by Devon Watson. Devon is the Executive Vice President of Global Banking and Chief Marketing Officer at Diebold Nixdorf. Within his organization, he is also responsible for business development and acquisitions. In my conversation with Devon, we discuss how Diebold Nixdorf evaluates potential acquisitions and why a good strategic fit is critical.
Yeah, Bela, I'm excited for this conversation. We both have known Devon for a long time, and he's a super smart guy and sees things that other people don't see. He's got this great vision. So I'm excited to hear what he has to say about acquisitions and what happens when an entrepreneur chooses to get bought by a big company rather than go the venture capital route, for instance. So I think with that, let's move to the interview with Devon.
Today's
Watson.
guest is Devon Watson. He works for Diebold Nixdorf, and he is the Executive Vice President, Global Banking, and Chief Marketing Officer there. Welcome to the podcast, Devon. And Mike Wasserman is also here. So between the three of us, we will have a conversation with Devon about sort of his experiences and a little bit about acquisitions. And he's been through a few of them there at Diebold. And we'll talk about that as the segment for this particular podcast. So Devon, before we dive in, can you tell us a little bit about Diebold Nixdorf?
You betcha. So first thing is we say Diebold Nixdorf because when your brand is over 160 years old, you never say die anymore.
Thank you.
We've been around a long time, always in the financial services industry, but innovating and changing the business substantially. So this was initially a safe company that kind of got its international start by surviving the Great Chicago Fire. And one of the few things standing was a bunch of Diebold safes. And that put us kind of on a road to prominence. At this point, we are about a $4 billion global company. We have over 20,000 employees. We operate in around 100 countries around the world. And most of your listeners will have used something that we made today, probably. We make many of the ATMs that you see, a lot of the banking software behind it, a lot of self-checkout devices that you see at the grocery store, self-checkout devices that you see at the airport, point of sale devices that you see when you go shopping. So our mission in life is to automate the way people bank and shop all around the world.
Excellent. That's great. Can you tell us a little bit about your background, how you got to where you are today?
Sure. So I've never had the same job twice. I've been in sales, I've been in product management, I've been in venture capital, I've led innovation, I've been in strategy, I've run operations for different parts of companies, I've run marketing, real estate, cost programs, IT, ERP. So I consider myself to hopefully be turning out to be fairly an all-around athlete for business, if you will. I've had the luck to be kind of on each side of growing and acquiring companies. So I've been an entrepreneur starting my own software company, which, Bela, I might remind you, I pitched you for capital and you shot me down brutally. I've been a venture capitalist, which was fantastic several years of my career, learning about different businesses from the investor standpoint. And then I've spent the last nearly 10 years at a large corporation where I've been the acquirer and integrator of two businesses over the last few years.
That's great. So I'd like to talk a little bit about acquiring and sort of, a little bit about that process. And I think integration is also a great thing to talk about as well. So to start with, what sort of, how does a company get into your sweet spot? Right. So how do they pop up on your radar screen? Sort of what do they need to be for you to sort of, knock on the door and say, hey, we'd like to talk to you?
That's a tough question to answer because hunting for an acquisition is, I would say, company dependent and the lens of the acquirer can be wildly different. If I look at how a software company would hunt for an acquisition, probably depending, and it even depends on how that software company is structured, right? If they're owned by the management team, they might be looking for a company that generates good free cash flow, and that would a profitable business would get you on their radar. If they're owned by private equity, they're going to be most likely looking for growth at all costs, and that trajectory is going to be the main driver of what's interesting to them. As a large company, there's a few different acquisition plays. Some of them are around, market share, trying to consolidate a marketplace. That was one type of acquisition that I've been a part of. Those are usually pretty darn big, though, right? You're usually looking for something that's half to equal your size. If you're looking at to acquire more of a startup, then the lens all of a sudden shifts out to the second and third kind of range of the innovation curve, right? Then we start hunting for what's the next thing that's going to take me into the future, right?
Yeah, very good. So when you look at, let's say, the startup phase, earlier stage companies, so not somebody half your size or as large as you are, but somebody that has maybe some unique technology you're looking for, or maybe they have a unique set of customers that you'd like to get after, right? So they have to have something that's of value to you, right? What are some of the various different things that you look for there? Can you expand on that a little bit?
Sure. So a technological advantage is super important, and that doesn't necessarily mean patents and stuff like that, because that's increasingly murky and in the software realm, getting more and more questionable about how applicable it is. But it needs to be something where that whatever that secret sauce is, either how they run the business, how they build the product, et cetera, is pretty darn hard to replicate and pretty differentiated compared to other substitutes, right? And that's the thing that we're really looking for, is something that we couldn't build ourselves quicker, right? Once you kind of have that, I'd say, beginning ingredient, proof of product market fit is by far the most compelling item. So if we can see that there are a core of very passionate customers who are so impressed by this value proposition that they're willing to pay more for it, that they're willing to speak about it, right? Being a public reference, things like that they're willing to tell other companies like, hey, this thing is so great, you have to get one too. Those sort of things show us that there's something of value that we can then put through our machine to grow it. So again, with the lens being on a startup, if you went from 2 million to 4 million last year, interesting, but I'm much more interested. You have 5 customers that are each 70% gross margin, right? They're each spending a meaningful amount of money with you. And the profile of that customer fits my existing customer list. Because I don't care about going from 2 to 5 to 6. I want to go take your technology and your customers that are evangelists, and I want to go to 10, 30, 50, 100, right? And I think that's one of the things that sometimes, startups, it's good to always, run a profitable business, for sure. Run a real company, have that discipline around the financials. But we, being the large company, can usually scale that a hell of a lot faster, right? Because we're going to put it through 400, 500 sales reps, not 10, right, et cetera. So we're looking for those indicators that say we can now scale this thing really, really quickly. Because that's also how we pay for the mathematics of an acquisition, is scaling.
Yep.
And is that how you compete? Because I imagine you compete with private equity and with VCs at some level, right? And so do you have to kind of make a pitch to the founders that they should take money from you, right? Rather than a private equity or a VC company. You might not have the big name, right? It might not be as sexy, but you can actually help them achieve their goals faster. Are there some other tricks that you use? Not tricks is the wrong word, but some other kind of selling points that you use why they should take an investment from you rather than a more glitzy source?
Yeah. So, at least for us, we look at it as a full acquisition. I want to answer your question accurately. There are corporations that would look at making an investment in that company, right, as a corporate venture capital, something like that. But the decision that I've been a part of a few times with founders is sell to an acquirer or go to private equity or to venture capital because you think you can continue to grow to something more and more profitable or to a bigger and bigger exit, right? And then they have this fork in the road. Do we sell to a corporation now and sell out, or do we keep building this thing on our own for the next several years, either under the hood of a private equity company or with venture capital? And having been in multiple startups, and having a lot of empathy for how hard that is, the advice I give is take the money and run. Right? I don't remember who sang that. Was it Johnny Cash? Whoever had that song, they were right. Take the money and run. There are so many things that can go wrong on the path to an exit. It is unbelievable. And if you go down the path of venture capital or private equity, it is hard to get chips off the table, but you can do that. You can negotiate some things, take a little bit of your value off the table to provide some security for what you've done. But you won't get the full monetization because, as Bela has often said, venture capital means you're now on a train and it is headed one direction and it's towards a bigger exit. And if you mess that up, you're probably going to lose your ticket to be on the train. Right? So it takes you down a very specific path, whereas, selling to a large acquirer kind of brings you to the end of that particular entrepreneurial journey. And I've actually had an entrepreneur turn us down for an acquisition, and I've provided the same advice. Take the money and run, because the market changes. The dynamics of the companies you're competing with is going to change every year. And unless you're on a trajectory where you truly believe in your heart that you can navigate that and beat everybody, especially in the financial technology world, things kind of coalesce towards the biggest players. And 3 years later, they got crushed by another large competitor, right? So through my lens, a big company acquisition is a fantastic outcome.
That's great, because I don't know that that's even the dominant business school logic, right? But your logic totally makes sense to me.
Well, and run the math from a founder's point of view, right? So, you build a business, you still own whatever, 10% of it, 50% of it, and a large company offers you $50 million to acquire the business. It's a great outcome. It's a lot of money. It's life-changing. It's a fantastic result of all the hard work. If you take venture capital, right, the size of most of today's funds means that they have to deploy a certain amount of capital into your business. You take that certain amount of capital multiplied by their ownership stake, and then multiplied by their the math of what will make a good exit for them. And you're now talking about swinging for the fences, right? You're not talking about a good exit any longer being $50 million. A good exit now is $1 billion.
Billion. You're a unicorn. Yep.
Yep. And then run the math on how many exits happen in the billions. Not very many. How many exits happen in the tens of millions? Tons. So that's why I say you really have to be a true believer to want to extend into that runway where the only good outcome is now massive, because the risk goes up.
Yeah, that's great advice. Yep. Great advice, Devon. So let me ask you a question, and sort of leading in towards the integration of an acquisition and what you kind of go through. But as preparing for that, what do you sort of look for in the leadership team and in the entrepreneur? What element does that play in considering an acquisition?
Yeah. So maybe I'll break down a few parts of the acquisition kind of courtship dance, right? So there's, you know, several stages of this where, we get under various levels of legal documentation and start looking at things. The first thing is there will be tons of time spent on the product market fit question. If the acquirer really knows what they're doing, that's by far the most important thing, because we'll be really trying to understand that if we can scale this thing by putting it into our engine. In terms of and then obviously a lot of technology due diligence, right? We're going to be looking for, is there actually something else underneath the hood of this technology that makes it work? Is it something else repackaged, et cetera? Is it truly really hard to recreate? Is your quote unquote AI function actually just a big pile of if then else statements that anybody else could figure out in 3 months, right? Separating the marketing from the real capability. When it comes to the management team, there's a fun saying that sometimes entrepreneurs make terrible employees, and which I've used on myself as well. But that's actually something that helps a big company, right? Is bringing in a team that still has that entrepreneurial spirit, can shake things up deliberately so that you start to run a portion of your business in a different way. So you're looking for folks that kind of fit the culture of your company, but not too closely, because you do want to shake things up a bit. Otherwise, you just do it yourself. You're also looking for synergy, which is a fancy business school way of saying how many people can I fire and how much cost can I get rid of when I buy this thing. So that's, just quite frankly, the other thing that an acquirer is going to look at. They're going to say, we've got this many folks. We've got maybe 100 developers. Few of them are super high priced architects. Which are the ones that actually know the things that are critical to making this asset valuable over the next 5 years? And which ones can I substitute with the ones I've already got on payroll? Same thing for sales, same thing for marketing, same thing for operations, finance and accounting, all that's gone. Day one, right? Yep. That's just going to get rolled into the mothership and replaced. So there's
Devon, Devon, let me interrupt you, because as I think this is a good place to talk about this particular question. There's some models out there where an acquirer will acquire somebody and fundamentally leave them as a standalone company for a period of time, and other acquirers will integrate into the mothership as quick and fast as possible.
Yep.
Do you have thoughts on those two models?
That's a great question. So the first one is a high class bet to be able to make. I'll put it that way. It's a luxury move to be able to make an acquisition and leave it fundamentally alone. Because it means that for the most part, you're not going to get those synergies in terms of how the P&L is working. There are a number of reasons that a large company will do that. We've done that in parts as well. And it's usually because the business that you're acquiring is interesting, but maybe 2 steps tangential from your core. And the reason to leave it alone is to, quite frankly, not break it. Because if you bring it into the mothership, the day-to-day problems of whatever the core business is will overshadow everything that company's trying to do, right? So if it's a longer range bet on the future, sometimes that'll happen. If it's closer to the core, and it's something that really fits the existing engine. And when I say engine, I mean the go-to-market engine of the company, right? They're the acquirer's ability to sell, the acquirer's reach into customers around the world, et cetera. You usually want to fold that in really quickly. Otherwise, you end up with the potential for a lot of confusion within the ranks. You end up with a lot of incentive problems, right? So if you're, selling software to banks, well, are the existing sales reps supposed to sell the old stuff or the new stuff? And how do you incentivize the sales rep to sell the new stuff if you've already got a sales force from the company you acquired? And now what happens if both those people happen to walk through the same door at the same time? Right. They just get an argument, right? It's better to get all that stuff out of the way. Everybody's on the same team and move forward. And the best companies at this move at just blistering paces. One of my friends had his software company acquired by a very large hardware and software company, and had the view that it might be standalone for a little while and he'd have a chance to get used to it. He said he came back to work, they had a nice closing and celebration on Friday, and he came to work on Monday and his email address was changed. The quicker you get it over with, the better, because fundamentally, once this happens, an acquisition it's a little bit scary. It's a little bit confusing to employees at the acquirer and at the target. Your goal as a leader should be to, as fast as possible, get absolute clarity on everyone's roles and goals, and then get back to work.
Yep. Just interesting you say that. For one of our, with one leg still in the VC business, we actually have a closing scheduled for later today.
Congratulations.
Yeah. So Monday morning, there will be certain employees who will be in a different world.
Yep, absolutely. Well, yeah. Congratulations. That's good news.
Yeah.
But it is amazing to me how things that a person outside an acquisition wouldn't even think of are complicated and expensive, that they are. The software integration, right? The merging the billing systems, all these things that seem like, oh, it's no big problem, it's no big deal, right? But it can take a lot of time and cost a lot of money. And then the cultural things, right? Oh, you're used to one leadership style and now you switch. Yep. It's fraught, right, with problems. And, some of the data are 50% or more of the acquisitions result in the acquiring companies losing, the shareholder value goes down, yep. Even though you've done your due diligence and you try to do all these things. Is there some learning that goes on? Are there some managers that once they've been through the integration process kind of know how to do it better and know what to look for, and then the rookies get kind of hosed because they make a bunch of rookie mistakes? Or how much in there is kind of this tacit knowledge of how to do one of these things?
That's a great question and framing. I would love to see the following answer printed in the press. The data that you reference would indicate that unfortunately the people that have no clue how to do it have billions of dollars to deploy. Right?
Yeah.
You're right. The track record is not great. Yeah, it's not great.
It's like picking a spouse. The track record's like picking a spouse. It's about 50%, right?
More people lose money on acquisitions than get divorced, or the other way around. I'm not sure, but yeah.
It'd be interesting to understand if there's a scale cutoff in that distribution curve. And I bet it's towards the upper end, right? Where things get really ugly. Because at the lower end, right, if you acquire something for $10 million or whatever, 30, 40, 50, you're really making a technology and portfolio acquisition. Those, I would assume, probably have a little bit better of a success rate, though harder to measure because you're betting on that being important in 3, 4, 5 years. There are certainly firms that are much better at this, right? That have a playbook for how they do acquisitions and specialize in it. Right? If you look at Oracle, they're awesome at it, right? They're really,
We do
really
like one a month or something ridiculous like that, you know?
exactly, exactly. And so there's certainly a discipline. Um, and I would say that that discipline has to come from the management team that's doing the acquiring. It can't come from outside consultancies. It's just too hard. And you have to make tough decisions very often around personnel really quickly, really, really quickly. To your point, Mike, on you know, IT systems and just other stuff that eats up capital and time, right? The faster you can bulldoze through those decisions, pick a direction and just go, right? Take the close is good enough and move on rather than deliberating ad nauseum, the more successful the integration will be. The cultural aspect is also tough to get right. So we did a very large, basically acquisition and integration of two equal-sized companies. And I spent nearly a year in the Netherlands integrating our software divisions. And it takes a lot of face time to create a new team, especially in this case, it was two teams that used to be fierce competitors. Our best go-to-market specialization was kicking the other one's butt. Right? We were
right, now you're sleeping together. Right.
Yeah, exactly. So you really have to, once you identify the talent you want to keep, make the tough decisions and get rid of some folks. If there's someone who's clearly not going to get with the program and, isn't moving quick enough, you got to take those hard decisions and trim quickly. But then you really got to spend a lot of time together, right? Like really understand the other company's point of view, build some relationships and trust. Otherwise, the time is ticking on your business case, right?
Yeah.
Yep.
Yeah. So let me ask you another question. If we think about internationally and we think about, a worldwide acquisition strategy, what role do various different labor laws, securities laws, customs,
environmental laws,
different countries, environmental laws, et cetera, play into
tax,
an acquisition? How does that how does that resonate?
It resonates like a cloud over your decision-making process. Put it that way. And again, this one comes back to size. So it's less of an issue if you're at the smaller end, but as you start to, get a reasonable number of employees, right? You're in the dozens or hundreds. It's really important. Right, is really, really important, especially if you know that you're going to change something about the business, right? So for example, if there was a interesting technology company with 200 employees in France, and I knew that I wanted the technology, but I could run it out of my existing operations, I probably wouldn't acquire it because I know I'm going to pay the folks in France probably until I retire. That's the way the labor laws work. I'm grossly simplifying, but it makes it very, very hard to get through the restructuring of your operations in certain countries. And actually, it forces really suboptimal decision making as well, right? There's somewhere between the American model of employment at will and, call it the French model of highly protected workers. There's something rational in the middle that's good for a company and good for a worker. The two ends of the spectrum are actually bad for both. And the reason is, if you get to the end of the spectrum that's theoretically great for the worker, the only way that you can get through what's called, the Workers' Council is if you close an entire legal entity, right? And maybe we're trying to rationalize half of a workforce. Well, 100% of the workforce is going to be the victim of the fact that the laws work the way they would work, right?
Yeah, yeah.
So it's definitely challenging, and it will it plays into how you think about your business case for how you generate value on the other side of the equation.
Yeah. So here's my last two questions. Maybe Mike has some more. question number one, if you had advice for entrepreneurs who, are starting a business or thinking about starting a business or have started a business and they want to get acquired, they've heeded your advice earlier. They're not going to go the private equity route, right? They want to get acquired. What advice would you give them?
Sure. So number one, I would make sure you really understand your potential list of acquisition, suitors, and get to know them, right? Have them in your Rolodex, do some joint sales with them, do some joint deals, whatever that might be. You want to be careful that you don't waste tons and tons of time and effort in business development, AKA expensing tons of dinners with no outcome. It's better to get really practical and tactical, rather than we're going to have a joint go-to-market program with all of these things, and we're going to negotiate a press release a quarter and blah, 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 blah. Forget it. Get to know one salesperson that understands what you do, understands what they do. Go see 10 customers and see if you can make something happen for real. Much better use of time, and it puts you onto their radar in a way where they really understand what the heck you're doing. That's number one. Number two, as those conversations start to come in, right, instead of talking to the usual salesperson or BD person that you do, if all of a sudden the COO or somebody else wants to have lunch, start to understand what their strategy is and why you might be interesting to them. Because then you can hone your story and explain your company in a way that resonates. And a big company, has a lot of different reasons it might be acquiring a smaller one. It might be that, we see a differentiator versus our competitors, and we really just want that kind of sizzle effect of a new technology. It might be that we're trying to branch out into a new customer base that we don't have access to. But you need to understand those so that you're setting the stage for how your company plugs that gap for us today.
Cool. Excellent. You actually answered my second question in your response to my first question. So, Mike, you got anything else?
That's great. We're right at 30 minutes, and I want to be careful of Devon's time. So maybe this is a good time to wrap it up. It's been a pleasure, Devon, and I wish you the best of success in your the near future and the long future with everything at Diebold Nixdorf. And we're happy to talk with you and gain some really, I think, interesting insights on acquisitions versus venture capital, and in the world of trying to build your own company's innovation portfolio, new technology portfolio through going out there and balancing, developing something yourself versus buying something that's already on the market. So thanks a lot for joining us.
Well, thank you for having me. Always fun.
Yep. Thanks, Devon.
So, Bela, that was really interesting. Within the startup kind of space, is an acquisition by a big company like what Devon is talking about, is this a significant portion of the exits that investors experience? That means when there's a cash out.
Mike, it's the vast majority of all sort of cash outs that happen through corporate sales or trade sales or acquisitions, as sometimes they're called. So, for example, in 2020, there were over 17,000 corporate acquisitions. This represents, a major portion of all of the exits in the private equity business. These are not just private equity exits, but the point is that companies get purchased all of the time. In contrast to IPOs, which is what you always gets all the glory most of the times, there were 470 IPOs in 2020. And 2020 was a very strong IPO year. In some years, there's, less than 100 IPOs. Some years there have been less than 50 IPOs. So IPOs go up and down, as do corporate acquisitions. But corporate acquisitions are clearly the vast majority of ways for entrepreneurs and founders to get cash into their pockets by selling their business.
Yeah. And, you lose the business in a sense, right? Because you lose control to the company. Sometimes they keep you on. In some cases, the entrepreneur sticks around for a long time. In most cases, they don't. There's a consulting contract, and then the entrepreneur fades away with a big cash out. But you can see that there's a lot more, as you said, acquisitions. It's a lot lower risk. There's a lot more risk that happens as the entrepreneur is growing their successful business and scaling it to get it to the point where it can support an IPO. And if you read the business press a lot, you see a lot about companies that were running up to IPO and failed. Right? Either they couldn't make it to the kind of the stage that they needed to get that capital, or something happened and the deal fell apart and they wound up getting bought anyways, but not for nearly as much money as they would have gotten in an IPO. And remember, in an IPO, yeah, the investor makes money, but so does the venture capital company. And so, the interesting thing that Devon talked about is, hey, you can kind of cut out the middle person a little bit in this, right? And you can kind of cut the VCs out of the landscape a little bit if you take that acquisition a little earlier in the game, before you might take the VC money. And then you don't get you don't have nearly the same risk. You might not get as much money, certainly don't have that opportunity for the big payday at the end, but you get a lot of money. And this business that you've built then can then become part of something bigger, right? And you can really scale globally, as in some of the examples that Devon talked about. What did you take from Devon's discussion about how at Diebold, they made acquisitions and he made acquisitions? Kind of what did you think was interesting from his perspective there?
Yeah, I think there's some really good points here that Devon brought up. And I think they're very generic points, meaning they're applicable across a lot of different types of acquisitions. I think one of the key things that the acquiring company wants to do is they want to take the business that you have, let's say you're the founder, and they want to be able to take that and leverage it and take advantage of their existing infrastructure, of the large company's existing infrastructure. So I always talk about it as they want to take your business and they want to hit the gas with it, right? They really want to push on the gas pedal and accelerate things and take advantage of their existing sales organizations, their existing distribution networks, their manufacturing infrastructure, their back office operations, because that's how they can really quickly accelerate and grow the business. And if they're going to leverage that and take advantage of it, then your business needs to be somehow related to what they already do, right? Their existing sales force, you want to be another page in their catalog of things that they're selling to their customers. And because they want to call on the same customers, right? So you're adding features, or you're adding another element or another capability to an existing product or platform they have, because that's what makes the most sense. They don't have to retrain their sales force. They're not out calling on different customers because of what they now sell, but they're talking to the same customers and upselling them into more features and more products. It needs to fit into their distributors, right? If they use distributors carry certain types of products. So you want to get into those same types of distributors. Same thing with manufacturing. If you're making a product that needs to be manufactured, it's not a pure service, then, does it fit into the existing flow of their manufacturing plant? Does the large company have some excess capacity that you can now take over and fill their pipeline with? So those are all things that I think they look at, and that's what large companies typically look at when they make an acquisition. How can they leverage it? How can they step on the gas pedal and really accelerate this? And from your perspective, that's wonderful, because it costs a ton of money to build out all of those things. It costs a ton of money to build a sales organization, a distribution network, manufacturing facilities, and it takes a lot of capital, right? So if you have to go raise that capital some other way in order to fund that growth, then you're going to end up owning a smaller percentage of your business. And, that's the thing you got to balance as an entrepreneur. Those are the challenging decisions you need to make. Do I sell now to a larger company, or do I try to build and grow all of this infrastructure myself with some help by raising capital so that I'll get to a larger place? And all of those paths are challenging. They all have probabilities associated with their success. But I think that for many people, being acquired by a larger company is a great path. and it's an immediate exit for you, the entrepreneur. You're getting cash in your pocket the day you sign the papers.
Yeah, and you and I both have had experience with that, and it's a nice feeling, right? Like, yeah, maybe we could have held on and gone bigger, but it's pretty nice to be able to get a chunk of money for a bunch of your sweat equity with that reduces the risk, and now you can go do something else with it. And I know in your case, you parlayed a couple of those into some really fun things and made a really nice life out of kind of doing that, from taking that right, the check essentially,
right,
or that money a little earlier. And me too. And it's not a bad thing. And I think there's this pride or something that you want to say, oh, I want to be the CEO of the unicorn that goes IPO. But I think there's a lot to be said for, yeah, I put a bunch of work in, I got paid really well, and then I took that money and did a whole bunch of other cool things with it. It is kind of neat too.
Yeah, you often see people who sell to a larger company, as we talked about with Devon. Sometimes the people don't go to work for a larger company at all. Most of the times you get like a 2 year as a typical sort of guarantee. You get a 2-year guaranteed job at the larger company if you're the founder of the small one or something. And sometimes people stay there and they have a great career and they enjoy it. But a lot of entrepreneurs are not cut out to work in large companies, and they realize that. And after 2 years, they leave, and then they take their money and they start another entrepreneurial endeavor. Right? You see that happen all of the time. You have these serial entrepreneurs. And just to be clear, if you decide to raise more venture capital or more private equity to fund your growth in sales, distribution, manufacturing, et cetera, there's still no guarantee that you're going to be at the head of that company, because your skill set may run out. And the people who put the capital in oftentimes have a disproportionate amount of control over decisions made in that company as compared to the size of their investment. So they're often the ones who are going to decide who's running that business. So there's risk in both pathways, but in one pathway, you do get an exit or personal exit for yourself, meaning cash in your pocket, and then that gives you some freedom of action to do other things if you so desire.
Yeah, and at least the times that I've kind of given people advice, I've always told them to take the money and go. Right, that there's so many other risks involved. And again, you and I have seen this a lot, and you can read about it all through the media, where the entrepreneur is forced out by the venture capital people pre-IPO, and they need to be, right? That they don't have the skill sets to take the business to the next level. And right, when you sell to somebody like Devon and a company like Diebold, that all that stuff is there. And it should fit right in. If the company like Diebold has done a good job of, here's our strategic identity, here's the fit of this acquisition, we know what we're going to do with it, it usually works out. And you still have some pride. Yeah, look at what happened now. This thing that I made, the software that I built, product that I built got is now part of an international network. So yeah, something to think about, and I think a really cool approach. I think, I don't know, let's say time to wrap it up, Bela?
Yeah, I think so. Let's wrap this one up, Mike.
Great. So takeaways today: as an entrepreneur with a successful startup, you have to remember that if you use venture capital to finance your business, right, you take that next step to grow and scale, you're either going to go IPO, or you're going to be sold to a company like Diebold, or you're going to fail, right? There's really just 3 paths, okay? And you want to avoid that failure one. We both have some scars there, right? You kind of want to avoid the failures, and you learn. Going IPO is just really uncommon, and there's a lot of risks along the way. But being sold to a company is pretty typical and pretty normal. The question is, do you do it earlier or later? Do you do it earlier and get a bigger share, or do you do it later after your share has been diluted? And that's kind of a really interesting question. The entrepreneur might give out the opportunity to have a huge payout, but they get a great return earlier in the process with less risk. So there's costs and benefits to both a VC investment and a corporate acquisition. And I thought Devon did a great job of comparing and contrasting these two forms of funding approaches for entrepreneurs as the company grows and gets ready to kind of either stand as an IPO or get bought. I guess the other option, and let's go back to talking about bootstrapping and trying to do it on your own. This is where a lot of companies don't have to make this choice of either Devon or IPO, right? It's, I bootstrapped it. I've raised my own capital through existing sales and through my own investment. And then I don't need to do A, B, or C. There's option D, which is just to continue along as a healthy growing concern. But that usually only happens when the company is self-financing. It doesn't happen when there's a VC investment involved. Listeners, thanks for joining us today. We hope you found this episode with Devon Watson both interesting and thought-provoking. If you have questions about what we've discussed, please feel free, as always, to get in touch with us. Our email is bela.and.mike@gmail.com.
And please do hit that follow button on your podcasting application. So until next time, signing off from upstate New York. See you soon, Mike.
Sounds great to me, Bela, from over here in Münster, Germany. I look forward to seeing you next time.